All right, guys, bang bang. I've got Darius here. He is suited up, ready to go. Got the tie on. Must be an important day, obviously. Let's start with the KISS portfolio construction method. This is something you guys have helped to pioneer, and I think is showing now why it works. But talk to us about KISS and what exactly that means.
Yeah, appreciate that, man. Thanks again for having me on. Ties on for now for the institutional client meetings, but for your party later, we'll keep the ties off for that. So looking forward to that, man. Thanks again for the invite. So in terms of our KISS portfolio construction process, this is our flagship portfolio construction process that we market and maintain for clients of 42 Macro. It was really born out of our pivot to transitory Goldilocks back in January, where we decided to stop shorting assets altogether. We had quite a tough Q4 last year, kind of getting squeezed, and ultimately went to the drawing board and really tried to lean on some of the, kind of core institutional learnings that I've developed throughout the course of my career in terms of developing this process. And what it's ultimately designed to do is help investors, your traditional money managers, traditional investors, regular retail investors, outperform 60/40 over the long term by introducing trend following elements into that strategy. And more importantly, introducing a permanent allocation to Bitcoin as a traditional asset class in that strategy.
Now, when you do this, you don't just create something out of thin air and say, we think it works. You obviously back test. You go and you try to figure out how effective has this actually been. Talk a little bit about the back testing and what those results really have shown.
Yeah, 100%, man. Absolutely. So this thing's been running live since January. Obviously, when we backtest anything here at 42 Macro, it's all with all the understandings and the understandings of what the proven quantitative techniques are in the business, and ultimately everything we construct is on an out of sample basis in terms of backtesting. But there's just a couple of highlights I throw at you in terms of our KISS portfolio construction process. So KISS, which is again a 60/30/10 portfolio construction that features SPY as the equity portion, AG as the fixed income portion, and BITO, at least for now, until we get a Bitcoin ETF, which we think is likely to be approved in the coming months. For now, as the Bitcoin allocation, which allows again, retail investors, traditional RIA type investors, and family offices really to gain access to what we believe are positive diversification benefits for Bitcoin as an inclusion in that asset class. So just going back to performance, we actually have a chart I sent to you. You can throw it up on the screen for production, where we show the hypothetical performance of a $100,000 portfolio since January 2018, both on a raw basis, but also in terms of the performance over industry standard reporting horizons. And what we find is that KISS, as it's currently constructed, featuring our trend following elements, as well as our top down and bottom up risk management overlays, which we'll talk about in a second, has a Sharpe ratio of about 0.9, which is more than double, which is about double 60/40, or double the Sharpe ratio of just being long 60/30/10 SPY, AG, Bitcoin in isolation without those top down and bottom up risk management overlay elements. If you look at the chart on the right, you see that KISS, our portfolio construction process, which is our flagship asset allocation process here at 42 Macro, is outperforming 60/40 on any relevant duration, and even outperforming the 60/30/10 raw approach on any relevant duration. And since exception. And then one thing I would say I'm most proud of is the max drawdown statistics, the risk management statistics, because again, it's not enough to just being able to be long assets. Any monkey with, a blind monkey with, peanut butter on its hands could be long assets. It's about keeping the money you make in asset markets for and having money to invest for the next cycle. And what we find is that, in these back tests, the max drawdown for our KISS, our flagship KISS portfolio construction process, which again includes 60/30/10 SPY, AG, and Bitcoin, and top down and bottom up risk management overlays therein. The max drawdown for that process is only minus 10%. And there's only one double digit drawdown, that minus 10%, since the beginning of 2018. You compare that to 60/40, they've had three max drawdowns in 60/40 since the beginning of 2018 that eclipsed minus 10%. There's a minus 12.5% drawdown in Q4 2018. There's a minus 22% drawdown in COVID, and there was a minus 22% drawdown at the lows in October of 2022. And then that also compares our minus 10.6% max drawdown statistic compares extremely favorably to the 60/30/10 raw approach, which takes that 60/30/10 SPY, AG, Bitcoin allocation and does not include our bottom up and top down risk management overlays. And there's been three crashes in 60, 30, 10 raw Bitcoin, SPY ag Bitcoin over the past, kind of 5 to 6 years. They crashed in Q4 of 2018. It crashed during COVID, down 23%, peak to trough, and then it crashed in 2022, down 25.3%. So the kind of quick summary is that, if you're going to add Bitcoin as a serious investor, as a traditional investor into your asset allocation approach, it obviously pays to have systematic, thoughtful, quantitatively oriented risk managements to guide that process along the way and smooth out those returns.
Now, when you talk about risk management, one of the things that's really interesting is everyone notoriously is long when they should be short and short when they should be long, right? Risk management is very, very hard when it comes to just the economic machine, different asset classes, different geographies, different rate environments, and the complexity just grows from there. You all have this macro weather model that you're really using to try to understand all these different inputs. Talk a little bit about how does that model work, and then what are some of the things that you guys pay attention to that may tell you, hey, now is some time we should be paying attention to some sort of risk management, whether top or bottoms up?
Yeah, great question, man. And so, we absolutely. So our weather model, macro weather model, is one of our flagship models that we use here at 42 Macro to help primarily our institutional investor client base understand the rolling 3-month forward excess return dispersion environment and volatility environment across asset classes. And we ultimately use that information to construct target allocation sizes in that KISS portfolio construction process. And so what this model is designed to do is actually regime segment all of the principal components of macro, whether you look at the real economy cycles between growth, inflation, employment, corporate profits, and fiscal policy, or whether you isolate the financial economy cycles, looking at liquidity, credit, interest rates, and positioning. And it's designed, again, to regime segment each of those core features of the economy and asset markets, and ultimately project the excess return and volatility characteristics that those regimes, currently project into each asset class. And so, kind of just a quick summary of the model right now, based on the current constellation of signals as is indicated by the component features in the model, things like our net liquidity model, which is so popular across global Wall Street, that balance sheet, TGARP, yada, 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 our global liquidity proxy, which will soon to be very popular across global Wall Street because that's a better model, things like growth, things like inflation, the fiscal deficit, aggregated positioning in the treasury market. There's all these different features in the model that are each contributing independently to the excess return dispersion projection for each asset class. And right now, what the model is saying is that over the next 3 months in the stock market, an investor is right to expect higher returns and lower volatility relative to the baseline return and volatility profile for that particular asset class over the next 3 months. That condition is shared by the bond market, and that condition is also shared by the Bitcoin market as well. The dollar and commodity signals are neutral, and so going back to our KISS portfolio construction process, how we implement these weather model signals into that process is via the top-down risk management overlay. Actually, if you throw that first chart back up on the screen where we show, if the weather model signal for the stock market, for instance, is bullish, the target exposure for the SPY is 60%. If that weather model signal for the stock market is neutral, the target exposure for the SPY is 50%. If the weather model signal for the SPY is bearish, for the stock market is bearish, and the target exposure for the SPY in this 60-30-10 KISS portfolio construction process is only 40%. And so we accordion the sizes of those target exposures up and down based on the rolling 3-month forward return and volatility projections as indicated by the signals generated by our macro weather model.
Now, let's talk liquidity management, because I think this is another big piece of it. Obviously, when we look at short-term treasuries and things like that, people are constantly trying to figure out, should I be holding cash? Should I be holding treasuries? Is there some other asset that I could hold? Liquidity, how do you think about it? And what are exactly people doing inside of this portfolio?
Yeah, great question, Pomp. So there's two things. There's two types of liquidity, right? There's the liquidity in your portfolio, in terms of the cash you have in your portfolio that allows you to buy more assets. Obviously, if you're maxed long at any given time, you're not unable to do so unless you have new cash injections. And then there's the liquidity that tends to drive asset markets higher and lower over the medium and long term in terms of things like central bank liquidity, private sector liquidity coming from commercial banks or non-bank market participants, or whether it be risk liquidity that we see spill over into reserve treasury markets vis-a-vis reserve managers. So those are two types of liquidity. The the second type of liquidity, i.e., net liquidity, global liquidity, the stuff that's currently helping Bitcoin accelerate in price, is obviously being captured again by our weather model signal, which is ultimately being influencing the excess return, dispersion, and volatility projections from that model. The bottom up risk management overlay in our KISS 60-30-10 KISS portfolio construction process, which again features Bitcoin as a core element, is really born out of what we call our volatility adjusted momentum signal. So that's just fancy, Yale lingo for saying, hey, we use a volatility overlay to give us a better opportunity to project whether or not the current conditions and momentum are likely to be sustained over the medium term. And right now, if you look at the charts we prepared for you, the SPY ETF, which again that 60-30 that 60 anchor and that 60-30-10 approach is currently bullish from the perspective of our volatility adjusted momentum signal. And so the actual exposure vis-a-vis the bottom-up risk management overlay in this KISS portfolio construction process equals 100% of its target allocation, which we said earlier is currently 60% because of that bullish weather model signal. The actual exposure for the AG ETF is also equivalent to 100% of its target allocation because again, the AG ETF is bullish in so much that the Bitcoin ETF is also bullish as well. So each of these core components of our 60-30-10 portfolio construction process are currently bullish from the perspective of volatility adjusted momentum signal, which means we are, from a dynamic position sizing perspective in terms of our trend following approach, we are at max long exposure from a dynamic position sizing perspective. If any one of these ETFs went down to neutral, then those positions will get cut in half from the perspective of that dynamic position sizing process. And any one of these ETFs broke down to bearish from the perspective of that volatility adjusted momentum signal, we'd see that dynamic position process cut those positions to 0%. And what that's designed to do, Pomp, is help investors who are, investing alongside our KISS portfolio construction process. It helps them maximize upside capture in bull markets, which we are currently doing for our clients all around the world, thousands of investors around the world here at 42 Macro. But it also, the top-down and bottom-up risk management overlays helps them minimize downside capture in bear markets by taking down their target allocations when the macro weather model is saying, hey, there are bad times ahead for each independent asset class, or when the bottom-up risk management overlay kicks in and says, okay, this particular exposure is telling you that there's more left tail risk in the months ahead based on our volatility adjusted momentum signal. So it's a complex process, but it's not a complicated process because it's extremely easy to implement as a retail investor or an RA investor, because you're only talking about ever having to risk manage 3 ETFs at any one time.
My last question for you is, I think, the question on Wall Street right now. Jerome Powell, he's got, 2 fingers, increase rates, decrease rates. Which one's he going to hit? Are we going to get the Bill Ackman Q1 rate cut? The market's pricing in 100% by the end of Q2. Bitcoin folks, the crazies on the internet, they're all buying Bitcoin because they think rate cuts are coming like tomorrow. What happens, and when should we expect to kind of see lower rates come into the market?
Well, the low rates are already in the market, right? If you look at market implied projections, as you mentioned, whether you look at overnight index swaps or Fed funds futures, there's a tremendous amount of policy rate easing price into 2024. Obviously, we're going to get to a overwhelming consensus on this sort of soft landing expectations in the market. And the reason we believe markets have coalesced around the soft landing expectation is because bonds are going up at the same time. If you had a no landing expectation in the market, you'd see stocks higher, bonds lower. If you saw a hard landing expectation in the market, you'd see bonds higher, stocks lower. So the mere fact that both asset classes are positively correlating still tells you that investors are currently really, centrally betting on a soft landing as that central base case. In our opinion, as investors, I think the average investor spends entirely too much time predicting and positioning for outcomes in the economy, and not nearly enough time reacting to changes in asset markets and changes in the economy as a result of a systematic investment and research and risk management process. That's what we specialize in at 42 Macro. We don't specialize in saying, hey, the economy is going to soft land, therefore you must do this. We think that's a terrible way to invest. And it's more than likely the reason why so many investors have really not made any money over the past few years, despite having several very important and awesome opportunities to make money, as indicated by that transitory Goldilocks call we pivoted to in January. So in our opinion, I think that to answer your question, it doesn't really matter whether we go into a soft landing, a hard landing, or no landing as an investor. As an investor, what matters is, are you positioned properly for rising expectations of a soft landing? And does that process you that allowed you to position properly for that, will it get you out, with a minimal degree of downside risk at the appropriate time once that soft landing expectation crescendos into a consensus and starts migrating to something else? And in our opinion, under having processes in place to do what I just said, it's way more important than predicting the future, which is why a lot of you, watching, continue to underperform, the broader beta in the markets.
Now, I remember seeing a study by Bloomberg that whenever we see soft landing articles spike, the number of them, usually that is followed very quickly by a deep recession. And so we've seen the spike. Will that hold here, or how are you thinking about it?
Yeah, no, I mean, look, with the probability of a recession in the U.S. economy materializing over the near term has risen in recent weeks, as indicated by some of the indicators that we track, specifically our 42 macro Fab 5 recession signaling indicators. One of those indicators in the last couple of weeks has breached its recession signaling threshold. So we went from a, call it a low probability of a near-term recession to a middling probability of a near-term recession. You don't have to overreact to that as an investor, because what we found in our backtesting and just in our terms of our qualitative analysis of the U.S. economy and financial market cycles is that the market tends to peak pretty coincident to maybe slightly ahead of the breakout in the jobless claims, the breakdown in total employment. So you don't need to put on a recession trade, like a year too soon, like a lot of the guys who've not made any money on Wall Street for the past, 12 to 18 months. So the reality is, the market and the economy and economic statistics will give you an opportunity to get out ahead of a recession. Might not get out at the exact high, but our goal as investors should never to be, top taking and bottom taking asset markets. What we're trying to do is help investors capture the maximum amount of trend in bull markets, and absolutely, be away from and not capture any of that trend in bear markets. And I think we're doing a fantastic job, if only because our research and risk management processes are so different than the average investor.
That makes sense to me. Where can we send people to find you on the internet or find out more about 42 Macro?
Yeah, thanks, Pomp. I appreciate that, man. So, we're at 42macro.com. Definitely come check us out. At Darius Dale 42 on Twitter. We definitely put out a lot of, interesting, educational, and helpful content out there to satisfy our audience. So we just want to say we appreciate everyone. Hopefully everyone's out there having a great year. Happy holidays, and we'll catch you back here in a couple of weeks.
You are the man. I appreciate you, and we'll definitely keep doing this. So thanks so much, and you have a great holidays as well.
You too, brother. Thank you.